Hey guys, welcome back to this video in our series to talk about the fundamentals of the stock market. Today we'll continue to deep dive on the candlestick patterns. And this will be the last few candlestick patterns that we'll talk about. And then afterwards we'll jump into the trends and channels, those types of more support resistance type of analysis. But let's finish up the candlesticks. And without further ado, let's get started. Over here, we see two patterns. One is called a bullish harami and the other one is called a bearish harami. I'll explain a little bit of what this looks like and then I'll explain the understanding of it. So for a bullish harami, it looks like a downtrend. Price is going down with red candlesticks. And then all of a sudden you will see a green candle, a bullish candle, that is a small portion of the red candle. It is within the size of the body of the previous red candle. And then this signifies that there's a potential bullish reversal, meaning the trend might be going back up, the price might be bouncing back up instead of continuing to go down. Let's understand why this is a bullish signal, right? The reason is because there is a momentum, right? When there's a downtrend or when there is an uptrend, the trend tends to persist. And this momentum is continuing and you see this giant big red candle. However, the next day, let's say we're looking at a daily time frame, right? The next day there is a starting price that's actually a little bit higher than the previous day's closing price. And the price actually gets pushed further up by the buyers to close out, even though it's under the starting price of the previous day, right? It is still a higher demand compared to the previous day. So this is a shift in momentum. All of a sudden, you don't see as many sellers anymore. Instead, the buyer is actually winning in this time frame. So in a similar sense, it is similar to Morningstar Doji, where you are seeing a previous downtrend, but all of a sudden now there is a momentum shift, right? And you can use this to predict a trend reversal. So just for the similarity comparison's sake, let's look at a Morningstar, right? We talked about this in our last video. There's a downtrend, all of a sudden there's a doji, meaning there's an indecision. And then all of a sudden you see that the momentum has shifted in the next candlestick where the price is going back up. So this is also a bullish signal, meaning that the price is about to reverse to the upside. All right. On the other hand, let's look at the bearish harami. So the bearish harami pretty much tells the same story as the bullish harami, except in the opposite direction. In this case, the price is going up, but then all of a sudden you see that in the second day, the starting price is lower than the closing price of the previous day, and the seller is pushing the price further down. There's more supply by the sellers, and they actually end up closing the price lower than the opening price. And this looks like the demand has been exhausted, right? There is not as much demand as the previous day. The momentum has definitely shifted. And the reason why I'm saying that the demand is being exhausted is because, first of all, the price actually opens lower than the previous day's closing price, right? And also, it continues to go lower, end up closing a price to be lower than the starting price. Both of these means that it signals a bearish candle for today, and it is a bearish signal for a potential trend reversal. In case that you guys aren't that familiar with the terms, when someone say if something is bearish, it means that the price is gonna go down. Whereas if they say the market is being bullish, that means the price is going back up. Let's move on to the last set of the candlesticks that we'll talk about today, which is the bullish and bearish engulfing. These two are very similar in concept compared to the haramis, right? Even if you just look at the chart, you might not even spot that much difference when you first look at it. However, if you look closely, you will see that the main difference is that the second candle is actually engulfing, meaning that it is bigger than the body of the first candle. Whereas for the Harami, the second one is smaller, is within the body of the first candle, right? Honestly, it doesn't really matter because both of them signifies a potential trend reversal. And for engulfing, what we can see for bullish engulfing, there is a downtrend at first, followed by a giant, a bigger bullish candle, right? This again means that there is a momentum shift. The buyers, even though they opened the price to be lower, right? The buyers came in very strong and they pushed the price all the way back up to be even higher than the previous day's opening price. Hence, this body of the second candle engulfs the body of the first candle. That's why it's called engulfing. This again is a very bullish signal, and it could signify a potential uptrend and a reversal from a downtrend. On the other hand, the bearish engulfing tells the opposite story, where there is a trend reversal from uptrend to now a downtrend, where there is a bigger bearish candle that engulfs the previous day's green candle. Okay, I want to again stress the fact that when you're looking at candlesticks, you don't want to focus on just the names. Sure, the names may be helping you to remember them, but you need to ultimately understand why a signal is bullish and why is it bearish. This again comes to supply and demand, and we talked about how the price is being determined in the market. It's determined by the orders that's being sent by the sellers and by the buyers. If there's more buyers sending more orders, buying the stock, there's more demand, then the price is going to be pushed back up. So in this case, we want to understand, okay, why is there a shift in momentum? And why this determines that there is a potential trend reversal? And what does these candles represent, right? And that will help you to actually then determine your strategy. These candles itself does not form a strategy. That you can't just buy at every single bullish signal and thinking that you'll make money out of it. That's not how it works. However, this could be part of your strategy, right? You might be looking at multiple things. If you're an investor, you might be even looking at more qualitative analysis rather than quantitative analysis, right? More than just technical analysis. If you are looking at trends, if you're looking at support and resistance, that's another part that you're going to be adding to your strategy. Using a strategy is a more advanced topic, and that's something maybe eventually we'll cover. But right now, let's give a few examples on TradingView to look at some of these candlestick patterns that we just talked about. So right now we're looking at Tesla on a daily time frame. You can also, of course, change it to weekly or monthly, but let's look at it from a daily standpoint. I highlighted two ones that could be a potential bullish engulfing, and this is a potential bullish Harami, right? Again, the candlesticks are not going to look exactly like the pattern that was shown to you. They may be a little bit variant, hence why you need to really understand what these trends really mean, what these patterns really mean, so that you're not just looking for an exact match. You're really trying to understand what is the supply and demand and what is the momentum and the structure of these charts. So in this case, we can see that there's a downtrend, right? There is a heavy downtrend on Tesla, and all of a sudden on this day, there is a huge push from the buyer side. The opening price is lower than the previous day's closing price. However, the seller pushed it all the way, the buyer pushed it all the way back up, and the body of this green candle, this bullish candle, is actually bigger than the previous day's candle, right? So it is engulfing it. And what do you know? From here onwards, we can see a pretty decent increase in terms of the price. So it actually, the price jumped up about 22% or more from the lows, which is great. So let's look at the other one, which, sorry, let me draw it out over here again. This is a Bullish Harami, right? We can see that even though there is a not as of a consistent downtrend, there is a downtrend over here, right? And you can see that there is a bearish red candle accompanied by a smaller bullish candle that's within the body of the previous. So this is the same thing as the Bullish Harami, very similar over here. And this also is a bullish signal. And from here onwards, you can see there is a slight price increase, although not as much. And this probably is around 15 to 20% as well. It's about 18% from the low point, right? So what you want to do as a trader is that when you see these patterns, then you can kind of think about, do you want to enter, right, as part of your strategy. And when you want to enter on the next day, or maybe around the time when this is about to close. You can see that you don't want to just enter predicting that this will be a engulfing candle. You can't predict that. You definitely should wait for the time to expire, for the next day to come, and then you see, oh, the previous day is an engulfing candle, and this is a bullish signal. Then maybe you buy around here, right? So you can't perfectly predict the top or the bottom of these trends. However, you don't need to get it correctly 100% of the time, and it's impossible. It's better if you're more consistent with your strategy, and that way it's a way better investment and trading strategy as well. Lastly, I kind of want to talk about cherry picking, right? Some of you might think like, okay, I just picked 2 points and it's very obvious that it's easier to look at the past and say what has happened rather than predict for the future, right? And that is very true. And I want to stress that because, you know, I can very simply take a look at this one over here, right? If I just take a look at this one, this could be a potential bullish Harami, right? You can see that the second day is smaller as a body compared to the previous day. And potentially this should actually push the price back all the way up to be further. However, it went further down. This proves the point that looking at these candlestick patterns alone does not form a strategy. You cannot just buy at every single candlestick pattern. And if you do that, it's most likely that you'll end up losing money anyways. But these are very important trends or important patterns for you to take a look at together with the trends, together with other topics that we'll be talking about in this series to form a more better strategy. And when you're a long-term investor, it's okay if you're not always buying at the very bottom, right, or close to the very bottom. You can use these patterns, these technical analysis together with your fundamental analysis, the ones where you're looking at more revenue, their assets, what is the price of the stock compared to the revenue of the company, and then use these fundamental analysis to determine, okay, this is a good company, so I want to find a good entry point for me to purchase the stock. Then you can use technical analysis to look at patterns, to look at maybe a longer time frame, on a weekly time frame, what is a good timing to purchase a stock. I hope you enjoyed the video, and if you did, please like and subscribe. Thank you so much, and until next time.